The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, the article on how you average matters is important.
Yeah.
Because I'm sitting here looking at the article and the math they do is if you're minus 18 in 22 and you're plus 24 in 23, you've averaged 1.7. Actually, it's 25 months. Because we haven't quite, we did. We finished today. So I'm looking at the high of yesterday. That's 25 months. And you have a total return. I shouldn't say that. You have a price return on the S&P 500 that is 1.6%. So let's just call it 2 years. That's less than 1% a year. Plus, you did get some dividends if you held it during that period of time. But that's still a long, long way to Tipperary if your goal was, or your expectations were, you were going to get an 8 to 10% return.
You bet.
Because you've got 2 years there where you're basically in the hole. You're way behind your schedule.
Way behind. And that's especially critical for people in retirement who are saying, well, I'm also going to have a 4.5% withdrawal rate. And that's based on my balance staying strong because of my 9% return rate I'm going to get. Well, no, how about a couple of, 4 or 5% withdrawal years with 1% gain or none or losses?
Or none. Losses, that's right.
That just blows you out of the water. And now none of the math works. And that's why we don't subscribe to any financial planning programs anymore, because they're kind of useless.
The math doesn't work.
No, it really does. It's a fantasy. It's a nice little exercise, but would it ever occur? Not in real life. No, it would never occur.
By the way, we should tell people who we are. I'm Don Creech.
And I'm Perry Sykes. And welcome to the Investor Resources Podcast.
We had a little experiment today. Anyway, that's a major error that people make. And then you turn around and you get panicked when the market does what it did on the last day of January, the Fed speak day, when Mr. Powell comes out and talks and says, well, I don't think we're going to cut rates. Despite all of you who are making assumptions and all you smart guys in academia and Wall Street, we just don't see the need to cut rates. We don't think it's wise yet. There's not enough supporting information to have us feel comfortable that it won't just blow up in our face like it did for Paul Volcker back in the 80s.
Absolutely. Same thing. Can't be too soon on that cut. That's right.
Yeah, he thought that he had whipped inflation. He had managed to implement what Richard Nixon wanted with the win button, whip inflation now. And he finally looked like it got under control, and they started easing off on policy, and all of a sudden inflation took off again, and they had to refire the restraints on the economic system. And that's what Mr. Powell's trying to avoid here. But be that as it may, the market yesterday hit an all-time high in the S&P 500. And the Dow's had several days of all-time highs so far in January. We have an all-time recent high for the NASDAQ, but we don't have an all-time high from 22, late 21, early 22, when the NASDAQ had its last all-time high. That's still to come. So the question that remains for most people is it over? Or is it too late? Is it too late to put my money in the market? I mean, I thought 5% was pretty good. Looks like we're going to get to keep it for a while. Is it too late to put money in the market? But you found some interesting research on bears that die together.
Right.
because trends, apparently all-time highs, happen to cluster together. When bulls find the bears have gone into hibernation, the bulls feel a lot more comfortable roaming around the pasture and heading into new territory.
And that's an important point. It's very important to remember that those all-time highs do tend to cluster, and they do tend to persist, not forever, obviously, But once they begin to occur, they tend to happen in bunches. And so it's not necessarily a good idea to say, hey, we're at an all-time high. That's a bad time to invest. I need to wait for a pullback. I shouldn't get in. We've seen so many people waiting for the good time to get in, and it really never shows up. And you end up staying out of the market way too long. And it's more important to remember that those all-time highs tend to gather. And so if you're in an atmosphere where you're getting all-time highs, there's no reason to believe there may not be a few more at least to come.
Well, that's consistent with basically our approach to money management, which is trend
Correct.
following. Uh,
Yep.
Academics can't figure out why this happens, but trends tend to persist.
Correct.
You can't replicate it in a math worksheet, but it's basically human behavior. It's a self-reinforcing look at the price, look at price charts, and you see things continuing to go up. Even if you're not a chartist, you're listening to the news, and what you hear on the financial media or the evening news is that the market hit a new high, or Microsoft hit a new high, or Nvidia in recent times has hit a new high. And you hear this news about all the good things that are going on in the market, and you say,
Yep.
my money's still in the credit union. What am I doing over there? I'm getting a lousy 5%, and the market's up 10, 12, 20. In some cases, I don't remember the stock, but one of the stocks that was mentioned in the news yesterday was up 800%. Oh, in
That's
fact,
pretty good.
yeah, actually, that 800%, I think, was related to Tesla, because Elon Musk, under the last compensation agreement, took no salary, and the board said, "We'll just give you stock options. You accomplish these production and efficiency and profit goals, and you'll get rewarded in stock." And somebody who owned 9 shares of Tesla sued and said that that wasn't fair, and a Delaware court upheld his objection and said that the
Right.
board the board has to go back and revise his compensation agreement after having the stock escalate by 800% over a 5-year term. Now,
Right.
my goodness, the guy apparently did not do his job. It's not worth his money.
No,
But
not worth it.
that particular court must actually be pretty dedicated to socialism. Let's see if we can elevate the level of pain that everybody suffers instead of make winners out of the deal.
As long as everybody feels the same pain. Yeah, we want everybody to hurt. Yeah, not just some people. So
That's the way it works
welcome to
in
socialism.
Argentina. It's everybody's is hungry and there aren't any dogs on the street anymore. So
It's scary enough. Yeah.
yeah, it is.
Hmm.
Anyway, we're talking about trends and all-time highs. Are we going to get more all-time highs? Now, we do not know the future. That's the first thing we'll tell you when you ask,
Fact.
well, what's going to happen in my account? And say, well, we don't really know. What we do know is how we're going to respond to what happens in your account when things quit leading, when money starts vacating positions in your portfolio and the price starts dropping. We're going to get rid of it.
Correct.
There will be some place else that money goes. Whenever something is falling in price, something else is rising, because for every seller, there's a buyer somewhere. There's always two people in a transaction. And if money is vacating utilities, for instance, right now it's been going into technology,
Correct.
goes into cloud services. It's been going into, well, it's actually been vacating electric vehicles of recent, though they did have a few years of good run. But money is fungible. It moves around. The market's dynamic. And so having a fixed allocation that says, I'm going to have, take an easy one, 60% stocks and 40% bonds, and my stocks will be partly international and partly value, partly growth. There'll be partly something in the market. And it's kind of like, frankly, throwing darts at the paper based on some questions that you answer, some questions that have nothing to do with market activity. And there's my portfolio, and now I go to sleep and everything will be okay.
That's the
It's not going
story.
to work out that way.
It's not. It never
No.
does. And those allocations are always made up on historical averages. And those historical averages have never been more dangerous than they are today, because the market trends and the direction of everything in the world can change so quickly now. And if your portfolio is based on 80 years of market history, so the last year, 2023, that's just 1/80th of what the input is into your portfolio. So the things that are happening now, the big trends that are shifting the way humanity is going to work going forward, do not get reflected in your portfolio for maybe a decade or two, until enough time has gone by to let those averages work out. So you are largely boxed out of the changes that are happening, and they're happening so fast right now, and the changes are so profound that you can't do that. You can't say I'm anchored to the past and I'm going to be anchored to the past for a long period of time and ignoring what's going on currently. It's one of the least safe ways to address your money issues. And that doesn't mean you want to be out there changing your portfolio 6 times a month based on headlines and what anyone thinks the newest coming thing is. But you have to be nimble enough to both get out of the way of old processes that are no longer valid and shift towards the new areas of the market that frankly didn't used to exist. Look at artificial intelligence. That's where the tech companies are all heading right now. Didn't exist 10 years ago in any meaningful manner. And now if you're looking at an 80-year stock average to balance out what your allocation is, you're not looking at it either. And that's very important, not to have gigantic blind spots like that in your portfolio.
Well, and you mentioned the 80-year average and say, well, what's that have to do with anything? Well, if you have a 60-40 portfolio or a
Yeah,
50-50, a 55-45, that's all modern portfolio theory that was developed back in the 50s by Harry Markowitz, who,
correct.
upon the retirement, said, I would never use that to manage my own money. But it's a great sales piece. It makes great sales presentations. There's no academic justification for the use of modern portfolio theory to manage risk in the portfolio, because the market doesn't care about your answers to those questions. What's important is whether or not somebody's paying attention to it. In a bull
Correct.
market, okay, so you can go to sleep. But when things are changing as rapidly as they are, as we try to unwind the impact of pandemic government intervention, which messed up not supply chains only, healthcare, manufacturing, labor pools,
Sure.
labor location. And government messes things up, and yet they want to be in control of everything.
As
But you,
always, sure.
you can't do that long term and adapt to the current things that are going on in the economy. That 80-year period is mostly because modern portfolio theory goes back to the 20s and says, look at average returns. Well, you will use those average returns and build your risk management out of that, without telling you perhaps that there are periods as long as 2 decades of losing money. That's not part of your plan. And you're going to be exposed to that with the next bear market rolling around if that's the way you close your eyes. I mean, it's basically an ostrich portfolio. I made my decision once and I will live with it forever.
Yep,
And
that's it.
yet, professional money managers don't do that with their own accounts. The only time they will say they do is when they have so much money that it doesn't matter whether the market loses 34%. And my guess is if you're watching us here, that's not you. You
That's
probably
not you.
don't have you don't have enough to say, so what? No big deal. I mean, I'll get it back over the next decade. Yeah,
Doesn't
if
matter.
that,
Yeah, that's not regular investing. That's not regular investors, and it's certainly not the way that we would treat any client's money. We don't think it's okay to have those kinds of drawdowns and do nothing about it. It doesn't mean our portfolios always go up. They don't. You're going to go through rocky periods, but you need to be making adjustments to try to get on the right side of whatever the market's doing, including just walking away from it, just saying, you know what, there's nothing here, let's go to cash for a little while and take a breather. But you have to be nimble enough and willing enough to look at what's going on currently to make those changes to a portfolio. And it's a safer way to do things.
And the issue is you need a process. It's not just,
Yep.
you mentioned willy-nilly decisions. That doesn't work. Can't respond to headlines all the time, but you need a process. What are you going to do to establish your rules? How are you going to check on it? What's your checking sequence? What's your checkup to find out if it's working? When are you going to determine if you should make a change or basically stay pat, sit still? And there are times when that's the best thing to do, but you need a process so that you're making rational decisions and not emotional ones. If you want help with how to do that, we'd be glad to explain what we do for managing our portfolios. Contact information follows right here. Give us a call or send us an email. We'll be glad to spend some time with you. It's a free look at what you're doing and what you're thinking about. Subscribe to the podcast. The link's right below. Have a great day.